We want to thank you. This is our 4th year doing this, and it has been thrilling for the entire team. Before we begin, just a quick word of thanks, and I know Charles already gave some thanks, but there's some more that's in order. First to Charles, who runs the conference business. We appreciate that from the editorial side. Dorothea's in the back. You've done an awesome job, and I appreciate it. Thank you. Tamara's here. Jerry's here. There is an army of people that make these things happen, and they deserve as much credit as anybody standing up here on the stage. And then there's one other group of people that desperately need a thanks, which is all of you, I hope, are DealBook readers and people who frequent our site, get our email, read our special sections, and see all of our coverage. We have an amazing group of people who do this, and they are tireless in the work that they do. And if we could, just give them a quick round of applause, and I'd be very grateful for that. Thank you. A last quick thank you. This summer marked the 20th year. I walked into the New York Times in 1995 when I was 18 years old. And so this is a 20-year party for me. It's been a remarkable journey, and I just want to thank the Sulzberger family for giving me this opportunity and giving all of us an opportunity to create DealBook and do all the things that we've done with it. So thank you to the Sulzberger family. Here's what we're going to do today. We have an awesome lineup. We have some great conversations. I want this to be as interactive as humanly possible. We're going to be calling on the audience. We're going to get into it. And there are so many issues to get into when you think about this theme of the long term. Really, what I hear and see as the existential crisis that we all think we're facing. What is the long term? Does it matter? By the way, I think there's a real question. You know, we've themed the whole day around long term. Maybe we're too focused on the long term. I want to hear about that too. Here's what we have going on today. As you know, Larry Fink is going to be coming out in just a moment. After that, Reed Hastings is CEO of Netflix. A remarkable company, a remarkable story. We're going to hear from him. Perhaps maybe he'll even make some news for us. Max Levchin is going to be here. This is one of the, if you don't know Max, I brought him here because I wanted to introduce you to him. I think he is unbelievable. After that, we have James Gorman, the CEO of Morgan Stanley. After that, we have Ginny Rometty, the CEO of IBM. After that, Gary Cohn is stepping in where Lloyd could not from Goldman Sachs. He's going to be here to talk to us. After lunch, Muhtar Kent, the CEO of Coca-Cola. It doesn't get better. And then after that, we're going to get into a conversation about venture capital with Peter Thiel and Chris Sacca. Chris Sacca, the new shark on Shark Tank, for those of you watching last Friday. After that, we're going to get into a conversation about cybersecurity. Then Al Gore is going to be here, and we're going to talk about sustainability and what that really means. And then picking up the rear at the end of the day, but it is really not the end of the day, we have Stan Druckenmiller and the one and only Carl Icahn. So a lot to do today, a lot of news that I imagine will get made, and I hope you can all participate in it. I'm going to bring out Larry, and I want to explain why I invited Larry to be here and to be here first. Larry sent out a letter, which many of you know, I wrote about it, to the Fortune 500 CEOs in this country and said, the buybacks, all of the focus on dividends, may be too much. And I want to get his reaction to what's happened since. And so I'm going to bring him out in 1 second. Before we do that, you all have clickers in your hand. We're going to play a little quick game just to get a sense of where everybody in this room is at in terms of their head on some of these issues related to the long term. So I appreciate you playing along with me here. We're going to put up the first question, if we could. And here we go. Generally speaking, it's a simple question. Is investor activism positive or negative for the long-term benefit of the economy and society? You can say positive, negative, or if you want, you can be not sure. We're going to give you 15 seconds. And the answer is, okay, this has been good. Carl Icahn will like this. Now, next question then. In the face of anemic growth and low interest rates, the current environment, let's call it, which is generally more prudent strategy for cash? Stock buybacks and dividends, or would you prefer that people focus on R&D, capital expenditures, or M&A? We'll give you 15 seconds. And the answers are interesting. sort of counters the activist idea, perhaps. Let's, last question, and this one's, to me, maybe the most telling. It's a hypothetical question for everybody, which is this. Pretend for a moment you're investing in a mutual fund, hedge fund, or other portfolio of assets. How many years of poor performance, underperformance of 5% or more, would you accept before selling it, assuming, and this is important, that the fund had outperformed the market over the prior 10 years? You can choose 1 year, 2 years, 3 years, 5 years. We could call this the Bill Miller question. And the answers are okay, so we have a pretty long-term group here. That's pretty good. I don't know if we're going to consider 3 years long-term. We will find out. Let me bring him out right now. Larry Fink is the CEO, founder, of course, of the BlackRock Group. He controls $4.5 trillion with a T. I should tell you, BlackRock just joined the S&P 100. Thank you for being here. And I should tell you, when he spun out from Blackstone, Stephen Schwarzman called this his heroic mistake.
But it wasn't his decision.
But it wasn't his decision. and you won't let him forget that.
Okay.
Let me start here. I explained to the audience the reason why I wanted you to be here and to be here first this morning was this. You wrote a letter to CEOs earlier this year where you said the following: with interest rates approaching zero, returning excessive amounts of capital to investors who will enjoy comparatively meager benefits in this environment sends a discouraging message about a company's ability to use its resources wisely and develop a coherent plan to create value over the long term. You sent that letter out. What was the reaction? What did people tell you? Were they happy? Were they sad? Were they angry?
I think all of the above, depending on what constituents who responded. I would say corporate America was very happy that there was another voice. Our clients, our investors who has allowed us to manage part of their monies and savings, I think they applauded probably overwhelmingly in favor of what we did. And then there was a few who disagreed with the whole concept of focusing on long term.
Let me ask you a question about who called you up and said, this doesn't make sense and we shouldn't focus on the long term?
Well, I'm going to say who, but there were some investors, friends, people I've known, called up and said, I don't agree. If we don't continue to push, we can't have, vital, excellent organizations.
Right. We've obviously...
And in some respects, Andrew, some of them are right. I mean, I think one of the reasons why the United States is such an incredible, dynamic country is because we have pushed our companies to become world-class leaders. But to me, there needs to be a balance. If you add up, we now have about $127 billion of money allocated to activism, up from $42 billion 5 years ago. We now have, we counted over 300 targets that are being attacked. Now, some of them deserve to be attacked. And let me just step back for a second. We have a group that works with companies as one, if not the largest long-term investor in the world because of the size of our index business, including our iShares business and our institutional index business. We own these stocks as long as these stocks are in indexes. And so we have to have a long-term perspective, and the only power we have is our vote. So, we do have active dialogue with our clients, and with our companies that we invest in. And in some cases, we do push them to do things. We don't do it in the public forum.
Let me just take the opposite side, though. We're in an environment that arguably you could say there's anemic growth. There are issues about demand, whether there's enough demand. Why tell a company to go out and invest in capital projects or R&D at a time when clearly they're looking at their business and they're saying, I don't have enough demand on the other side. Do you buy that? Because that's the argument.
I didn't say that in the letter. In the letter, I asked them to give us a long-term business plan, including what is your long-term intentions for growth in your company. So R&D and CapEx. The second question we asked over a 5-year period of time, what is your plan towards inorganic or organic activity? And the third question was, what is your 5-year plan related to stock repurchases and dividends? So we wanted to have a dialogue over a long-term strategy, including those three components of a long-term strategy, and then having that long-term understanding with each company, we can then mitigate and manage around the company's actions. If we see a company that is talking about reinvesting back in their company, and indeed we see them not doing that, and they're just aggressively buying back shares, even with or without an activist, we can have that dialogue. So I think the whole concept of activism was taken out of context. What we wanted to do is have a better understanding with the companies as to what are their long-term plans.
Okay, let me ask you this. You wrote, it is critical to understand that corporate leaders' duty of care and loyalty is not to every investor or trader who owns the company's shares at any moment in time, but to the company and its long-term owners.
So that was probably the most controversial sentence in my entire letter. And I did that probably with knowledge that this was going to cause that controversy. And my claim, and this is where a lot of people can argue because every shareholder has equal rights, my claim was your duty and care is with your investors who are with you for a long period of time. Now that's where we can have a lot of legal debate, but I truly believe that companies need to focus on, for society's purposes and for this country's purposes, long-term solutions.
So if I own a share, even if I only own it for 6 months, I should not get a vote?
No, I didn't say that. You said that. I said, there's always...
But effectively, you want to prevent, I would think you'd want to prevent me from getting a vote if you want to focus on these long-term shareholders.
No, I believe each owner of a share, as long as they represent one vote of shares, should have that vote. So no, we are not saying it. But what I'm trying to say is you should be listening to your long-term shareholders more with that view. And so what we're trying to do is give them long-term guidance. But we are not trying to change the whole concept of stock ownership and a vote.
Okay. You also have a policy prescription that I want to ask you about. You said that a more effective structure, this is a tax structure, would affect everybody in this country. More effective structure would be to grant long-term treatment for capital gains after only 3 years, and then to decrease the tax rate for each year of ownership beyond that, potentially dropping to 0 after 10 years. This, you say, would create a profound incentive for more long-term holdings. What has been the response to that?
Mixed. I mean, some people, there's some people who believe that will not change behaviors. Certainly does not change pension funds' behaviors because they don't pay taxes anyway. But I do believe we should be looking at tax policy as a carrot and a stick. We misuse tax policy always as a stick, and I do believe we need to rethink what long-term is. And I do believe if you reconstruct how we design long-term capital gains, I believe it will add to more long-term investing.
Some people would say this policy, though, would be self-serving to BlackRock.
In which way?
Self-serving in that you say that you own the shares for the long term and the rest of the world arguably doesn't.
But 70% of our investors are pension funds.
And so you're saying they wouldn't be impacted at all?
No.
So then why make the argument?
Because I think it's right for society that I think we are so focused on the moment, the 24/7 news cycle, the blog. I think we are losing credibility. I think we as a business community are losing credibility with society. And I believe that we have to be focusing on more long-term issues. I think tax policy is one way of effectuating it. Washington is just as guilty. We don't have any governmental policy related to infrastructure. So I could go on and talk about all the short-termism that we're seeing in this country. But I don't see how that will benefit. I really did it with the idea that I do believe it will force behavior changes. Right. Also, I thought it would be good for small businesses. Forget about stock ownership. Small businesses, when they, I think one of the big problems they have is if they own the company for tens of years, they have the burden of paying capital gains and then estate tax that could be quite considerable.
Hillary Clinton has followed suit to some degree, talking about quarterly capitalism. She wants a plan that includes what she says is a 6-year sliding scale for capital gains taxes. Individuals in the top bracket would pay ordinary income tax on the sale of investments, 39.6% in the first 2 years, and then the rate would decrease each year over the next 4 years until it returns to the current capital gains rate of 20%. What do you think of that plan?
Well, I think she threw out a plan. I think it was somewhat similar to what I said. I do believe if I remember correctly, her plan did not have any descending rate. I do believe we need to have it descending. You could argue whether 3 years or 6 years is long term, and that could be all debated. What I was trying to propose is something was tax neutral. I would imagine if you extended out 6 years, it's tax. It would be an added tax to society, and I was trying to construct something that was not. I didn't want to get into the policies of trying to raise taxes or lower taxes, and so she is using it as a mechanism to raise taxes.
Let me ask, because I think it's a question we all have, which is you've now gotten involved over the past couple of years in policy debates.
That was by mere accident.
Do you want to have a role in Washington ultimately?
As I said loudly and clearly, probably not clearly enough, I love my job. I think I have the best job in financial services right now, and I'm extremely happy where I am.
But if Jack Liu's job came available?
As I said, I am very...
Have to try.
You're not going to get me to change that as my statement.
I got to try.
I am very happy with my job. As I said, I wake up in the morning excited about what I do every morning.
Let's talk about activism for a second, because you have been outspoken about activism. I know you think that people have maybe twisted or misunderstood your words. At a conference earlier this year, you said there are good and bad activists. So what's the criteria and who are they?
Well, I'm not going to get into a personality contest at the moment, but let me just start off and say one thing. Forget about. I'm going to change the answer.
Punt on the question?
Yeah, no. Here's something that's alarming. Forget about if it was an activist cause or non-activist cause. The S&P 100 companies in the last few years are paying out 108% of earnings through dividends and stock repurchases. That's just not, that can't last. Paying out more than you're earning in stock repurchases and dividends. We've gone way beyond our abilities, and I think that could be a possibility because of some activists, or it could just be what I would call bad management, who are focusing on short-term actions to try to defend their position in business. So, but to answer your direct question, there are some activists who have ownership longer than some mutual funds. They are public in the manner in which they invest. But if they have long-term plans in holding the stock, I don't have a problem with that.
So it's the long-term. By the way, Carl Icahn, one of the longest, in terms of holding periods, actually typically owns the shares much longer than most other activists. Do you put him in a good category? I know you've had the troubles with him.
Did I?
I heard.
You heard?
I heard.
I'm not aware of that.
Let's talk about a different topic then.
Good.
Actually, it was a topic that Carl Icahn though raised, and it's about ETFs.
Yeah.
And there is a big debate going on Wall Street right now about the risks associated with ETFs, specifically in the high-yield world. And Carl Icahn's come out and talked about it. Howard Marks has come out and talked about it. Stanley Fischer's come out and talked about it. I want to read you something. This is going to appear in the New York Times actually on Thursday in a special DealBook section that Landon Thomas has written. This coming from Peter Krause. He's the CEO of AllianceBernstein, former Goldman Sachs man. He said, "Let me bring it down to reality. And this is about what happened to ETFs over the summer. You guys woke up one morning in August and the Dow was down 1,090 points, And on that day, a $40 billion ETF traded at a 30% discount. That should never happen. If your client traded on that day, you will never get that back, never. These funds may have low fees, but they are not safe, and your clients need to understand that. You say what to him about that?
He should learn about. He should learn more about ETFs. So let me go over it. So you talked about what other people talked about high yield and and then the quote that you have is about equity ETFs.
That's true.
So let's talk about both.
Okay.
So on August 24th, Asian markets were down 5%, and futures were down over 5% in the United States. And the stock exchange suspended trading in certain stocks. They did not suspend the basket of currencies called ETFs at the same time. So for a 90-minute period of time, and in some cases only 90 seconds, there were some stocks, ETF baskets that had big discounts because nobody had price discovery because the stocks were not trading. So at that time, you don't even know what the real discount was because some stocks were not trading. By the time all the stocks reopened, the ETFs were back trading at parity. We have taken this as a serious issue. We have been working with the New York Stock Exchange and the SEC alongside other ETF players. But this is, I think most people, maybe not Alliance Bernstein did, but have cited this as a market structure problem. And now we have to look at, if you're going to freeze certain stocks, you're going to have to freeze the baskets too at the same time. And so we look at this as a good wake-up call. We're looking at this as serious, and we can't accept that type of market action. But I would not be as hysterical, but I would address how do we fix the potentiality.
But what is the fix then?
The fix is first of all, the ETFs in the same category in Europe did not have that problem. So all the ETFs in Europe that moment, during those 90 minutes or 90 seconds, depending on the ETF, had none of the discounts. And a lot of it has to do with the specialist function on the floor and the arbitrage function. And so we are working with the exchange to try to change it. I know the SEC's involved in it. But I think almost everybody I've spoken to who has done any degree of investigation have concluded it's a market structure issue. Now, let's move to bond ETFs, where, quite frankly, for a year there's been quite a bit of debate on bond ETFs, and no one ever talked about equity ETFs. Everyone thought that was going to be fine, and yet the problem was, on August 24th, an equity ETF problem. Actually, bond ETFs performed absolutely fine throughout that day. So if people understand how an ETF trades, they would understand if you're worried about bond ETFs, you're going to have to be a lot more worried about bond mutual funds. And in the case when I speak to every regulator, they understand it. They understand if we're going to be worried about the mismatch of the underlying asset to the liquidity of the product, then we have a bigger market structure problem in the entire mutual fund arena. So an ETF is like a stock, or is a stock, so every time you have a sell order, you have to have a buy order. And so you actually reduce the demand for selling and buying throughout the day. A mutual fund aggregates all the buys and sells at the end of the day. You have all the uncertainty of what the price is, and you have to wait until after 4 o'clock to mix and match, and then you have, whether it's a day where there's a huge amount of selling or a day where there's a huge amount of buying, that's when the mutual fund company has to go in and make those trades. Right. So the problem is the structure of those problems are all at one moment where you have the mismatch. In the ETF structure, it is actually less risky because you're mitigating the supply and demand issues on every trade.
Final question for me, and then I want to open it up, which is this. We think about too big to fail. It's my favorite question. You know I always like to talk to you about this.
I think you wrote a book on it.
Yes, but you now control $4.5 trillion. I think actually the market's up, so that number is probably even higher. How much did you have under management?
4.5. That's
4.5 trillion. That's kind of like a lot of money.
That's the last public.
So the Financial Stability Board said back in March that the failure of an asset manager could, quote, cause or amplify significant disruption in the global financial system. Why should you not be considered
But
a
that was
SIFI?
March. You haven't gone over the June one and yesterday's announcement.
The new one.
The new announcement saying they're looking at activities of asset managers, right. and they have determined that managers themselves may not be systemically risky. And so they are now moving towards activities. They applauded the SEC.
When you think about your firm, and then real quick,
Yeah.
what do you think the biggest risk is within the firm?
Oh, like every other firm. The biggest risk we all face with is individual malfeasance or just, cultural breakdowns. To me, that is the biggest.
But if your computer system got hacked or computer system went down, that wouldn't cause a massive disruption. Wouldn't that be a systemic, forgetting about something larger than that, no?
We don't have one computer system. We have backups in many different parts of the world. So for that failure, it would be probably a systemic failure for many financial institutions. Okay. So the answer is, I don't sense that as an issue. What I do worry about is making sure we have a culture that every citizen of BlackRock worldwide has a high standards of making sure we do our business appropriately with all our clients. But I think the issue of asset management systemic risk has been so heavily discussed and digested, and I believe regulators at this time, they're going to still, they keep the door open. The door never closes because they may change their opinion one day. But at this time, the approach has changed, and I think appropriately they're looking at activities of all asset managers. So the SEC has taken a leadership role in this right now. They've addressed for comment, what do you believe liquidity related to mutual funds, addressing the whole issue of bond ETFs, and they're asking about the potentiality of stress testing all mutual funds. I do believe the SEC will ultimately go after leveraged products, and I think when they attack activities as an example of what they may be looking at, it will intersect all players, including hedge funds and private equity firms.
We have time for a couple questions. Let's try to open it up. Sir in the middle there. I think we have a microphone coming, if we could. Can you get that down there? Great. We'll go rapid fire real quick.
Larry, two simple interrelated questions. I applaud your goal to encourage long-term investment. With that concept in mind, why are pension funds treated differently under the tax law than individuals? Conversely, why do people who invest in equities pay a much higher tax rate effectively than people who invest in other asset categories like commercial real estate, art, or things like that? And Section 1031, Larry, we can't use it, they can.
Well, I think there's a long history of tax code related to pension liabilities. It's by having inability to pay in taxes. In theory, these pension funds have the ability to accumulate the appropriateness of their pension assets. I strongly believe tax code should be reviewed across the board. Hopefully our Congress one day wakes up and does a full review of our tax code and address all these issues. I would say, though, the biggest long-term problem in America, the biggest issue beyond any one bank, any healthcare issue, is the inadequacy of retirement. This is going to become the crisis, the biggest crisis in the United States in financial services, because 80% of Americans do not have the appropriate retirement. And this is why more and more Americans are going to need to work longer, especially in light of longevity. But I do believe we have not addressed, when we think about long-term, is the inappropriateness and lack of funding for retirement.
Larry, thank you. We're going to pick that piece of the conversation up with Stanley Druckenmiller later this afternoon. Good. We appreciate it. Thank you, Larry.
Thanks, everyone.
Thank you for the questions.